Hello, this is Mike Swanson, and I run the website WallStreetWindow.com. And the odds are you're watching this video because you got an email from me by being on my email list. And now, if you're not on the email list, click the link associated with this video so you can subscribe. And if you're just randomly watching this on YouTube and you've never seen me before, click the subscribe button on the YouTube video below it, and then click that bell too, because then YouTube will send you a notification as soon as my next video is up. Because there's a lot of interesting things happening in the markets. Last week, we saw the start of earnings season. The market rallied or had a bounce into earnings after falling 10% after Labor Day. And then it kind of went sideways last week. We actually saw some companies such as Wells Fargo announce earnings, then dump, which isn't that unusual. Often when stocks rally into earnings, they see some profit taking as the announcements come out. And often even the stock market itself as a whole tends up fading a little bit after the third week of earnings. So this could easily happen again with the overall picture on the charts. Doesn't mean the market's going to collapse or anything, but it's just typically what happens. But there are people out there calling for a giant drop after November, and particularly after the first Tuesday in November. I'm not. In fact, I think the market reaction may be much less than people are expecting. However, I do think there is a difficulty factor that now exists in the financial markets that all investors face. I face, you face, anyone investing for the long term now does. And almost no one is talking about it. And I'm not talking about stock drops or crashes, but something else. And that is the bond market. Most people will put, let's say, 50% of their money in stocks and then 50% of their money in bonds as a safe haven. Because historically, when there's been a drop or a correction in the stock market, bonds have gone up. So one could own, by owning 50-50, when stocks drop, your bonds go up, you sell some of your bonds, you buy some more stocks, you could just do this continuously. And that strategy would beat the market for decades, if you back test it. And that's what most people do. If you go to an investment advisor, most investment advisors will recommend this strategy. You may be doing it yourself on your own. However, there's a problem now with it. And I want to show this to you. I got to share the screen here, some of my charts. So here's the S&P 500. And of course, it crashed 35% about in March, then rallied sharply. But after Labor Day, there's about a 10% pullback. Now, historically, on such a drop, bonds would go up. Treasury bonds would go up. And that's why people put so much of their money into them as a safe haven. But this time, that did not happen. So here's the TLT ETF, which tracks the 20-year Treasury bond. And yes, it soared in March as the Federal Reserve lowered rates to zero, because this bond goes up when interest rates go down. But in September, the Fed didn't lower rates anymore. So that's one reason this ETF did not go up like it would in the past. Instead, it did nothing. And in fact, since August, this ETF is down. Since May, this ETF is below the high of that month too. It's actually performing worse than the S&P 500. It's performing worse than the price of gold. This plot on the bottom of this chart is a relative strength plot. It's a ratio taking TLD divided by GOLD. That's the price of gold. And when the plot goes down, it means TLT is underperforming gold. And it's been doing that since March. So the point is, I don't think having a lot of money in bonds makes sense anymore. For one thing, you don't get any interest. And that's why there's not much upside in TLT, because when rates are zero, it really has no much higher it can go. So without that upside potential, what there is risk. risk of inflation down the road. If you buy a 10-year treasury bond that doesn't even pay 2% yield and inflation gets to 2.5% or so forth, then you are losing value on your money, guaranteed. That's not good. You don't want to invest in things where you're guaranteeing yourself a loss like that. And then you got the opportunity loss of locking your money up to get nothing in return for it. So the only way I can see buying any bond now is if you're doing it for a very short-term time frame, such as a 1-month CD, a 1-month treasury bond, maybe 30 or 3 months or 90 days out. But other than that, it makes no sense. Why lock your money up for 10 years and get no return? You know, all you're doing is risking higher inflation down the road. Don't do that. And many people are saying, no, I'm not going to do that. And that's one reason the gold market has been outperforming the bond market. So if we look at the price of gold, gold itself has actually been outperforming the U.S. stock market since October of 2018. Actually, it's been outperforming the Dow since March of 2000. But regardless, the relative strength plot on this chart, comparing the price of gold to the S&P 500 on the bottom of the chart, shows, boom, in February and March and April, gold outperformed the stock market. Yes, you can see in March, gold dipped. But when the stock market dipped about 35%, gold fell 1/3 less than the stock market did, so it outperformed. Then it came back faster than the stock market, made new highs faster than the stock market. Now, since the end of August, gold has been in a consolidation correction phase. It will end once gold gets above 1950, and it could do that next week. It could do that next month. I'm not trying to predict that, and I'm not making this video to make a prediction. I just want to draw yourself to your attention to what is the biggest problem now going forward for all investors. It's not the risk of a November stock market plunge. It's the fact that interest rates are near zero, and therefore bonds no longer function well as a tool to diversify yourself and as a safety play against stock market volatility. Instead, you got to do something different. And there's no simple solution. It was simple. Oh, I'll just park all my money in bonds and I don't have to do anything or really think about it. Not anymore. So now we have to diversify into many things in that safety portion of our accounts. Yes, I think gold can be part of that. It is part of that for me. Silver is too. Other commodities are too. And so are some foreign currencies, and so are some very short-term CDs and bonds. That's how I'm managing risk. No longer am I putting half my money in treasury bonds or half my money in American CDs. I'm spreading out in many different things. And that's how I'm managing my risk. And I think now that's the prudent way to do it going forward for the next 3, 5, maybe even 10 years. So it'll be interesting to see what this chart here of gold does, because unlike bonds, gold has incredible upside potential. I think the run in gold has only begun. I see gold as a buy on any dip. Right now, the downside is basically the 150-day moving average. And if we break 1950, another run will begin. So it's going to be interesting to see how this plays out. And I'll be talking with you later. Again, subscribe to my email list and subscribe to this YouTube channel by clicking the button and the bell. You got to click that bell after the subscribe button.